All right. Hello again, everybody. It's Michael here with your second installment of the educational series I started a few weeks ago, looking at the different aspects of supply and demand. Before I go ahead, I just wanted to say a big thank you to all of you who've been in touch since that initial video. It's been humbling to see the response. I really wasn't aware that there was so much appetite out there for that kind of video. I just wanted to sort of straighten things out based on the things I'd been seeing online and on YouTube and to help people out. But the response has been really humbling. This second video has been a little bit delayed because I've been ill, still recovering, but I'm well enough to be able to do this one. So I thought I'd get it out because a lot of you have been in touch wondering when it would be released. So here we go. So again, it's really for me just to clarify a lot of the basics around supply and demand. And as I've said in many of my previous videos, please be aware that there is nothing new under the sun. There is no perfect system. There is no holy grail. Supply and demand is definitely not a holy grail. It's one of many potentially profitable methodologies that can be used to approach the market. So be mindful when you are watching the YouTube videos. There's a lot of great content out there from supply and demand traders, but there's also a lot of inaccuracies in some of the videos. So just be mindful of that. There are a few people who are really great at it. FX Telepath, Moneyball Austin, Alfonso Moreno, the original Online Trading Academy team, who've put out a lot of videos over the years. A lot of them are really useful. So just bear in mind as you're going through those YouTube videos and trying to learn this yourself, as to what information you take in, and think about the information yourself. Does it make sense to you? So what I'm going to do on this follow-up video is pick off from where we left off the last time, which was, I did say we would look at how we draw these supply and demand zones. So the first video we went through how to identify them, which is starting with, current price going down and left and looking for large up moves. If you're looking for a demand zone, let me get this tool probably easier. So if you're looking for demand zone, you're going down and left and you're looking for this big candles. You're not looking for bases to start with. You're looking for the big moves. Your candles can be green, white, black, whatever color you want to make them. Your background can be black. It really doesn't matter. But what you're looking for is big price movements. When you find those price movements, you trace them back to where price is last based before the big price movement. That's where you find your base. Similar for supply, you're going up and left and you're looking for big moves in price. As you can see, I'm highlighting significant price movements as you go up the price ladder. That's what your eyes should be looking for. When you find the big moves, then you can trace them back to the last area where prices seem to stall and go flat sideways before the big drop, and that's where you'll find your base. And today, one of the things we're going to do is look at how to draw the lines around those bases, whether they're supply zones or demand zones. Remember, we also said in the first video that there are only two types of those price formations. Two for demand, two for supply. The rally-based rally, the rally-base rally demand, the drop base rally demand. Only two types. And for the supply, it's the rally base drop and the drop base drop. Those are the only four formations of price that you're looking for. So drawing them. Let's start with the demand zone. So here is a demand zone formation. For those of you who've already seen the first video or who may be practitioners already, you will recognize that this is a rally. It's a base with a rally out. So this is one type. When drawing the zones, you're going to use, or I would suggest, using the Fibonacci tool, which is really a measuring tool. And I'll show you how to format this now. So once you get the Fibonacci tool, it actually on TradingView looks like that. That's the default that TradingView comes with. To get it to a tool that you can use to draw the price levels around your zones, you just simply modify it by taking out all the Fibonacci retracements apart from 0 and 1. You can take them all out. You can click on extend the lines. You want to extend the lines to the right because you're going to be looking forward in price, obviously. So let me move this aside so you see how things change as I make the alterations. So if you click on that, that's the first thing. You see where it says trend line? You may want to keep that. I prefer to uncheck it, and you see the dashed line disappear as I do that. It just makes it cleaner, less lines on the chart. You can change the colors of your lines, whether you want red on each one of those, or whether you want different colors. You want one of the lines to be black and you want the other one to be, I don't know, teal. You can change that. And you see how the color in between the two lines changes? Well, you can either keep that, as you see here, as I increase the opacity, it changes. You can remove it entirely, or you can leave it to a certain degree if you want the colors on your charts. I tend to leave maybe a little bit or none at all. And you can uncheck it. You don't even need to drag it all the way down to 0. You can just uncheck it if you don't want it there. Okay, I'm just going to change these two lines to black so you see where they are now. Now we keep going down. So what we've done so far is remove the trend line. We've kept the line thickness, but you can also increase the thickness of the lines if you wanted to. In there, you can make it a dashed line if you wanted. You could make it a dotted line if you wanted. I tend to keep mine just solid and a 2 usually, but you can do whatever you want. And then we're talking about the prices. So you see here the prices are also listed, as well as the levels 0 and 1. So you should leave the prices if you want. It'll help you visually. I'm going to move this now to this side, so because there's lots of changes going to happen over here. So you can keep the levels if you want, 0 and 1. You can leave them with the prices, or you can take out the levels and just leave the prices. Now where it says labels, it's referring to the prices. So you see they're to the left of the lines, and they're on top of the lines, which is where it says top there. You can put them in the center, and that just depends on how far back you draw the line. So if I remove this, for example, there we go, and we drag it out, you see the center lines move that way. So you can leave it like that if you want. I wouldn't advise it because it just seems a little bit odd. So what you might want to do is go to the right. You can leave the lines. TradingView, the older versions used to only allow you to be able to leave the lines like this on the tops of the lines, which work absolutely fine. More recently, though, they've added the ability to put the price levels in the middle of the line, so you can see that there. For some of you may want to put it at the bottoms of the lines. Who knows? Everyone's different. I tend to put mine in the middle. And then you can change the font size. This is also another new addition. You can make the numbers bigger, so that you can see them. You can make them really small if it's not that important to you. Whatever you want to do with those prices, you can do. Okay? So that's how you would modify your tool to use to draw the levels. So we've got our tool. Now we're going to draw them, use this tool now to draw the lines around the price levels. When we're looking at a demand zone for supply and demand traders, these two lines are given particular names. The line closest to price is often referred to as the proximal line. Is often referred to as the proximal line. Let me make that black as well so you can see it more clearly. The line closest to price is referred to as the proximal line. Let me make that line as well. And the line away or furthest away from price is referred to as the distal line. Just like we would in medicine when we're describing structures in the human body, proximal in front, distal behind. That's all that means. There's nothing else. So those are the two lines. So with drawing the zones, for demand zones, the distal line is the easiest line to draw. The distal line is always placed at the lowest price in the base. So I'm going to zoom in on this so you see it. When we're looking at this structure, that's the rally out, that's the move out, that's the candle that attracts your eyes when you look to the left from where price is at the moment. That's what you see. Like we said earlier, you trace it to where it started from. You're looking at this base. This base consists of 3 candles. Yes, one of them is also a relatively strong up candle, but there are certain characteristics of this that make it not ideal to be used as a rally out candle. For one, it didn't close above the candle before it, which is a filter you can add. You don't have to. It just makes it easier. You might want candles that close above the candle before them. 2, its price range is still mostly included in the price range of this candle. The majority of its price range is still inside that. So you might not want to say that that's a rally out because it's not a significant enough move away. It's still all part of the base, which is really, the base is a price range, high to low. For the distal line, it's always at the lowest price in that base, which is on this candle. So if we say this is a rally and this is the rally in, this is the rally out, everything else is the base. Everything else is the base. So where is the lowest price in the base? Let me just take this one out. It's right there. So you're not putting it at the low of the rally in candle. You're putting it at the lowest price in the base. That's where the distal line always goes. And you'll see for supply zones when we draw it, the distal line also always goes at the highest price in the base. For demand zones, the distal line always goes to the lowest price in the base, whatever that is. Okay. Now, where supply and demand traders have discretion, and everyone is different here, is where they put the proximal line, which you will recall is this upper line here. Where this line goes is where supply and demand traders have discretion. There are a few ways to do it. The first would be just put it at the highest high in the base. Really straightforward, no drama. I put the distal line at the lowest price in the base. I put the proximal line at the highest high in the base. That may work for a lot of zones. Sometimes it may not be appropriate to do that, depending on the volatility that was in the zone, meaning the size of the candles, basically. If the candles were quite large, you may find your zone is quite wide, and inappropriately so, for example. Okay, so that's the first place you could put the proximal line. Remember, the distal line always in the same place, the lowest price in the base. The distal line, lowest price in the base. The proximal line is where you have flexibility. So highest high in the base. The second option is to put it at the opening price or the closing price, depending on what kind of candle it is, before the move out. So you're trying to get that proximal line as close to the origin of the move out as possible. You could do that. So, and that's the commonest way that supply and demand traders do it, where you put the line, again, let me bold that up, where you put the line at the body of the candle just before the move out. That the color of the body is not really relevant. It can be green, it can be red, but you want to put it body of the candle preceding the rally out. Okay, that's another way that you can do it. The final way that some supply and demand traders do this is by putting the proximal line at the origin of the rally out, the opening price, basically, of the rally out. Now, as with trading, as I mentioned in the first video, there are pros and cons to everything we do. There are always trade-offs. So if you draw your zone like this, there's nothing wrong with it. The advantage is you are going to be getting a better price if and when you get triggered into a trade. You're going to be able to build up a bigger position size, for example, because your entry is going to be closer to your where your stop will go. So you'll probably be able to have a slightly bigger position size. You'll be getting a better price than the person who put it here, at the body of the candle preceding the rally out, or the person who put it there. Now, the person who put it at the high of the highest price in the base is more likely to be triggered into their trade. That's the advantage. The disadvantage is, obviously, they are further away from where their stop would go, wherever that will be, meaning that their position size may not be as large as the person who put theirs here. It's always up to you what suits you, what you do. Don't let anyone box you into a corner and say, this is the only way to do it. That's never the case. It's always a variety because we're all different. So if you put it there, that's kind of like the happy medium in the middle, where, you're not too high, you're not too low, it's not too hot, not too cold. I believe that was Goldilocks. I think I could be wrong. Goldilocks and the Three Bears, I think that was. Yeah. So that's where most people put it, because it's a happy medium in the middle. You want to put it right there, the body of the candle preceding the rally out. That's one way of doing it. Okay, I hope that is clear. Now I'm going to do just one example, but I'm not going to talk through it as slowly as I just did. That was the initial one. So I'm going to go to a different type of demand zone, which is the drop, the base, and the rally. It's going to be exactly the same thing. Distal line goes to the lowest price in the base. Proximal line can be at the body of the candle preceding the rally out, which is this candle right here. It can be at the body of this candle, which is the candle preceding the rally out. You can put the proximal line at the top of the highest at the highest price in the base, which is also, it happens to be this candle because it's still part of the base. It wouldn't be a rally out, obviously, because it's so small and it's not a big move. Even though it closed, you'll notice it closed above, all of these. It's not, you wouldn't really say that's a rally out. I would hope not anyway, after you've watched all these videos over the years. That's not a rally out. That's a rally out. That's what would attract your eye. So let me just take this off. So you want to put the proximal line at the highest price in the base, or you can do the Goldilocks and put it somewhere there, which is the origin of the origin, the body of the price, the body of the candle before the rally out, I should say. In this case, that also happens to tally with the origin of the big move in price. So the option 3 that we talked about, where you could put it at the origin of the move out, just also happens to be the same price as this candle preceding the rally out. So that's just a accident, I suppose. So that's an example of a drop, a base, and a rally out, and a rally base, rally out. So those are the two types of demand zones. Let's do supply zones now. So again, you're starting from current price, you're going up and left. We could use that one, you could use that one. I'm going to use this one just for explanation's sake. So again, as we said earlier, when you are drawing a supply zone, the distal line is the easy part. The distal line, the furthest line away from price, you're putting it at the top, the highest price in the base. There. Where you put your proximal line is where the discretion is. Again, you can put it at the lowest price in the base, which would be this candle here. Let me zoom in that one again so everyone's clear. So that's the lowest price in the base. You could put it there. You can put it to the body of the candle preceding the large move out. Let's bring that up. You can put it to the body of the candle preceding the large move out. And again, in this instance, the third option of putting it at the origin of the large move out just so happens to also line up with the body of the candle preceding the move out. Okay, that's again something that's just the case in this case. It's not always the case. Okay, so that's supply. Let's zoom out again and let's do the rally base drop example. So again, that's an example of a rally base drop. You see the rally preceding, you see the base, and you see the drop. Okay, so distal line always goes to the highest price in the base. Proximal line goes to the lowest price in the base, and I'm going to need to zoom in really for this one because they're very similar prices so you can see it clearer. It can go to the lowest price in the base. It can go to the body of the candle preceding the move out, or it can go to the origin of the move out. Now again, think advantages and disadvantages. This trader, the supply and demand trader who draws their zone like this, if and when prices come back to this level, they are likely to get filled at a better price. The disadvantage is they may never get filled. Prices may come to this level and just drop, but their entry is up there. So they may never get their order filled if prices just came here and tagged the trade in and it then fell. So that's the disadvantage of making the zones that tight. But in terms of, getting filled, your chances are less, but your position size could be bigger because you're also closer to where your stop would go. wherever that is up here. Okay, so that's the advantage and that's the disadvantage of drawing it like that. Drawing it like this, obviously, as we said, this one is also like that happy medium where the chances of getting filled are good, the position size is decent if prices do come back, and then you can take the trade if everything else lines up. Obviously, multiple time frame analysis and trend and all of those kinds of things may come in depending on your style of using supply and demand trading, even, zone scoring as well. Okay, so those are the two ways, or the different ways, I should say, you can draw for the two different supply formations that we have in the methodology. It's really not that complicated. Where you put the lines is distal line always the easier of the two lines to put. For supply, it goes to the highest price in the base. For demand, it goes to the lowest price in the base. The proximal line is where you have your individuality. You can do whatever you want. There are different ways, as I've just shown you. Okay. Now, before I finish this video, and I think the next one, I'm thinking about doing one on multiple time frames. But before I finish this video, I wanted to touch on the topic of trend and momentum lines. Okay, because that's something that I've got a lot of questions about over the years, and in fact, in recent weeks and months, because it's for some reason a little bit unclear to some of our code traders. So I wanted to touch on that before I finish as well. Now, when we're talking about trend and momentum lines, let's be clear. There's no secret to this. They mean the same thing with a slight difference. Trend lines are the traditional trend lines you draw using the original technical analysis education we probably all got, where you are looking for peaks and troughs and connecting them. You're looking at a high in price, you're looking at another high, and you're trying to connect them to give you the, direction that price is moving, the rate at which it's moving, whether it's a 45-degree angle, all of that, good stuff. As you know, or you will recall with technical analysis, the more touches there are to a trend line and the further back it goes in time. If you're drawing a trend line from, going back to 2020, for example, it's stronger than a trend line that you started drawing, which started from, last week, right? So the further back you go, and the more touches there are on the trend line, the better. They say that you need 2 touches to draw a line, which is true, but you need a 3rd touch to confirm it as a valid line. So, for example, this trend line I've just drawn, going by the technical analysis tenets, it wouldn't be a valid trend line yet. It's a potential. It's got the 2 touches. You can draw a line, but you haven't had the 3rd touch. Okay. And trend lines are also, just to mention, dynamic. You find people saying, well, I can't really fit a trend line in. If I draw a trend line like that, well, that had 3 touches. You're going to have to change that. If, for example, when this market went, almost parabolic up here, this trend line may not be relevant just yet. It's still worth keeping it on, but, if you don't want to clutter your charts, you may not want to do that. But you might have to update your trend line to something that is more in line with what price is currently doing at the time, which might be something like that. I mean, that's not a very clear, clean trend line, but it follows what price is doing. Price is staying on one side of that trend line for the entire move, and then it breaks up there. You might want to adjust it to get that in, but you don't have enough touches. You're looking to touch that. So it is a subjective practice. Is it valid for some people? Yes, like anything else in the market. For some people, no. There's no point in trashing it. I don't know how we got to this stage of, trashing other people's methodologies and claiming they don't work. Everything works in the market at one point or the other. It never is the methodology, as I tell my traders. It's always the person implementing the methodology or the approach, how much understanding they have of it, how skilled they've become in their practice, and how diligently they apply the knowledge. It's really that simple. Okay, so those are the traditional trend lines, everyone. You can draw them as you wish. Momentum lines are slightly different, and that's where I think the confusion has come in. I call them momentum lines just to be able to differentiate it in my head from the traditional trend lines. Yeah, I sometimes draw trend lines on my charts when they're appropriate, the traditional ones. The momentum lines they have slightly different rules. The rules are that you're looking for the two most recent. If you look at Tom DeMark's work, he does a lot of work around this approach of drawing trend lines. You're looking at the two most recent peaks. Number one. If you're drawing this is for drawing a downward momentum line. That's the first thing. The second qualifier is when prices left those peaks, did prices make new lows? If you're drawing an upward trend line, you identify two lows, the two most recent lows. If prices were like this at the time, the two most recent lows would be those two lows. The second qualifier, when prices left those troughs, those lows, did prices make new highs relative to the highs to the left of them? To the left of them. Did prices go to new highs to the left of them? If the answer is yes, then you can draw the upward momentum line. If the answer to the question, did prices make new lows relative to the lows to the left of price, relative to the lows to the left of price, those troughs, I think that low, let's have a look. Let's put the magnet on. That low was what? 118,616.7, 118,540.4. So that low is lower than that low. So that peak there made a new low relative to it. And that peak obviously made a new low as well. So your momentum line, which is really just a gauge, and you can use RSI, stochastics, CCI, whatever indicator you think will help you to see that better, because like I said, a lot of people have struggled with this concept of the momentum line. You may want to use an indicator if that makes it easier for you to observe momentum. There's nothing wrong with that. Again, don't allow yourself to be boxed in. You do what suits you. That's the momentum line, the current momentum line. And the idea of this is you're gauging the most recent momentum of price. Now, you'll notice in this case that prices have moved significantly away from that momentum line. And the idea is if you break it, it's an early warning sign. It's actually the earliest warning sign you can get of a potential change in trend. What it actually signifies, everyone, if we have a break of this line, and by a break within the supply and demand methodology, we're talking about an open, high, low, close candle away from the momentum line. You might choose to use a particular percentage over the momentum line. If you choose, you might choose to use two closes above the momentum line and one open, high, low, close candle above it. It's entirely up to you. What you've tested, what you've observed in the markets, in time you've been trading, there's flexibility there. The basic rules are you want an open, high, low, close, meaning one period of trading above this downward momentum line. If it were an upward momentum line, for example, you want one period of trading. Where's that arrow? one period of trading, which would be right here, the open, the high, the low, and the close of this candle, right here. Let me take off the magnet. Of this candle right here, the open, high, low, and close is away from this momentum line. Yeah, this one would not suffice because it's still in touch with the momentum line, but this is the first real indication of that momentum at that time coming to an end. If we have a similar picture, we come up here, we have an open, high, low, and close candle above this line. That would be the indication that that momentum at that time has ended. Remember why we chose these two peaks. There are two peaks that made new lows in price relative to the price levels to their left, new lows in price relative to the price levels to their left. That's why these two peaks qualify. Okay? This one would also qualify because, as we said earlier, when prices left this peak, we looked at the prices below this one, and we saw that this was obviously lower than this one. So, and prices fell from there, from this peak to that new low. So at one point, the momentum line, which always also, like the traditional trend line, needs updating. This is a very good example, actually. I'm glad I picked it randomly, but I'm glad it's here now because I can talk about it with you. So what you notice, you had this peak, that peak, they both made new lows, so they qualify to be used to draw the momentum at the time. Now look at this candle here. It's open, it's high. Let me zoom in a bit there and bring it into focus for you. So it's open, it's high, and it's low, is away from that momentum line. That's the indication that, okay, that momentum has ended. Now, something really important I want to say to you is, because momentum has temporarily ended does not mean that it cannot be reestablished, which is why you constantly need to update your momentum lines. They go with price. As you get new information, you have to update your charts with the momentum lines. Okay, so here we have it. You have a break in the momentum line at that time, and prices then dropped and reestablished new momentum. So you're going to have to update this line and pull it that way. Remember when I said that momentum lines were the earliest indication of a potential trend change? Well, the fact that they're the earliest indication also means that they're the ones that have the most whipsaw. They're the least reliable. So it's an early indication. So it's a warning light. Doesn't usually mean take action. It's a warning light that, alert, be on alert, something is changing. That change may totally not happen. But it's for you to be aware, to sit up in your chair, as I say, and take notice. So when that break happened, you would be sitting up in your chair and thinking, okay, that's happened. That momentum has ended. Now, something supply and demand traders will say as well, and it's valid to a degree, but again, there are so many other filters you have to apply. Is when you break an end momentum with this candle, that there is a demand zone that is created, which would be here. Let me make that yellow. So a drop, a base, and a rally. Well, that's true, but how much of a move out do you get? Do you have enough of a move out to trade this pullback as it came out? Clearly not. This barely moved 1-to-1 when it broke out, but then immediately sellers saw that rally as an opportunity to get in short at a better price, and they've done that. So you want to be mindful when you're applying these tenets of chart analysis with supply and demand, to always be mindful of what you are looking at in terms of price action, in terms of the basic rules. Do you have a big rally out in price yet? Not quite. You had a rally out and then prices just paused. And you're waiting to see, would this end up being a rally base? Could this have gone, instead of going down red, could this have gone up and gone and be, let's make it green? So you see, could it have become a rally base rally? That was the potential, because you really, really wanted to take out that high for you to be more comfortable, because that's the where sellers last came in for the move down. It's not really a supply zone you would draw, but it's a high where, because sellers come in at the highs, buyers come in at the lows. I hope everybody understands that. So you really wanted to see that kind of action, so you could have a rally-based rally, which would have been backed up by a drop-based rally behind it, sort of a level on top of level. But that's not what you got. So if you had been waiting to see this kind of action and then you saw the red candle down, you didn't lose money. You didn't get into a trade because you say, well, it's broken the momentum line. This is a demand zone. I'm going to place my order to buy at the proximal line here. That's not a good idea. Okay. So I think that was everything I wanted to touch on today. If there are any other kinds of videos regarding supply and demand that you wanted me to do, just email me. It's storehouseanalytics@gmail.com. It's on your screen, the top right. So I hope you all find this, useful. And remember, trade your way. Learn the basics, trade your way. There's only, the charts we have. We're all looking at the same charts. It's how you apply the knowledge you gain and dedicate yourself to your practice. I wish you well. Take care, everybody. Speak to you again soon. Bye for now.